welcome back. Time for a check on regional markets, and Asian shares are seeing a broad sell-off. Sentiment's being weighed by geopolitical uncertainty over a possible US-led military strike against the Syrian government. Japan's Nikkei share average is down for a third day, with exporters leading the declines on the back of a rising yen. The gloomy outlook is also casting a shadow on the Australian market. Shares are slumping, with miners being pressured further by weak metal prices. With interest rates on the uptrend, investing in property is looking less attractive. So are there still good investment opportunities in Asia? To talk more with us about property investment this morning is Paul Guest of Lasalle Investment Management. Paul joins us from our city studio at OCBC Centre. Thanks for joining us today. So which property markets in Asia still offer attractive yields for investors then, Paul?
If you're an investor looking for higher yield, it's gotten quite a bit more difficult. Prices have continued to move up even while fundamentals have deteriorated in some markets. And as you mentioned earlier, rising interest rates without a sustained economic recovery or strong economic recovery yet means the pricing of property is going to come into question. So it's hard to find high-yielding, attractive markets. You need to move into development. From our perspective, where you're moving into development, you need to look for things that have long-term underlying demand and a current shortage of supply. China logistics is a good example. Australian residential, although I would say apartments, not houses. And again, you have to be selective about your markets. Where we've also been successful is in Japan logistics, but that ground is getting more crowded. There's been a lot of entrants, particularly in the last 2 years.
Well, let's talk about the market here. Do you think the Singapore residential property market's heading for a steep correction following all these government cooling measures we've had in the past 2 years?
Yeah, you do have to split up the Singapore market between different segments, mass market versus luxury versus high-end. The luxury and high-end segment's already been hit by the government measures. You haven't seen prices move, volumes are way down. Mass market pricing is stabilized, but there's been continued high volume of sales. Of course, there's a lot of supply being built. If you go out to the parts of the west of the island, parts of the east of the island, a lot of supply and mass market coming on board. So I think we are going to see a correction in the market. The government, fortunately, can remove some of the measures, ease things, and that's going to ease the depth of the downturn. So they do have a way of mitigating any potential correction and avoiding a steep downturn.
What about retail, commercial, and industrial properties? Are they still offering attractive yields?
All of those markets, particularly income-generating, good quality properties, whether it's retail or office or industrial for that matter, all saw prices continue to rise, even as particularly in office terms, we saw rents decline for most of last year, in fact, right up until the past quarter. That means that the properties have looked pretty expensive. If you're a long-term investor, a sovereign wealth fund, an insurance fund who wants income, that's still attractive, but there is no upside. The upside's been traded off. If you're looking for higher yield or return, they're really pricey at the moment. The income-generating properties are.
So tell us about the market across the border in Malaysia, the property market there.
Malaysia prices have moved, not as aggressively as they have here or in Hong Kong. Really depends where you're looking in Malaysia. Some investors look at Iskandar as a proxy for Singapore. That's moved prices, not dramatically, not to Singapore's levels, but of course you have different levels of infrastructure provision, different institutional and political concerns, so it shouldn't be priced the same way as Singapore, even though it's next door. Moving deeper into the country, sectors like retail are attractive. Offices have been heavily built and particularly heavily invested in by domestic investors, so again there the pricing looks pretty steep. So as a sector, retail is probably one we would find most attractive in that market.
Further afield, is Hong Kong's property sector any better than in Shanghai and Beijing?
Hong Kong struggled for the same reasons as I mentioned here. Fundamentals deteriorated, rents fell, you had a rise in vacancy, particularly in Central, and prices continued to move up. In fact, a record price per square meter was set last year with the purchase on it was purchased by a Chinese domestic bank. I can't remember the exact name of the property at the moment. But the end result is that it looks even more expensive. And when you have the government's measures to bring up Kowloon East as a decentralized market, you have the potential for a big delivery of supply, quality supply, not far from Central, what London called the Canary Wharf effect. So the medium-term returns, there's a big risk there, even though now rents are starting to recover, and it is still a key gateway market, but as I said, expensive.
Right. Now, the Australian dollar's lost around 13% against the US dollar since mid-April. Are property prices there looking attractive then?
Australia is an attractive market to all sorts of international investors from across the globe. One of the challenges was the price of the currency, and as you correctly say, that's now changed. Hedging costs are still high, so that's an important consideration for international investors. There, the spread of yields, whether it's office or industrial, not so much retail, but are at record high spreads over the risk-free rate. So from that perspective, it is attractively priced. There are tax considerations and, as I said, hedging cost considerations that foreign investors need to think about. But from a purely property perspective, it is an attractively priced market at the moment.
Just one more question for you then, Paul. What about Thailand, the Philippines and Vietnam? Are you upbeat on their long-term prospects?
These are markets, we've invested historically in Thailand, we've not in some of the other, call them second-tier markets in Southeast Asia. They all have attractive demographics, growing incomes, an expanding middle class, the things that make hotel investment, retail investment, residential investment attractive. But these are very obvious demographic drivers, and there is a lot of domestic capital. So we've seen a lot of residential building in these markets, we've seen a lot of hotel construction. So really your key question as a foreign investor is partner risk, is picking the right joint venture partner on the ground who knows those micro markets and can avoid that supply risk or competition risk. So upbeat, to answer your question, upbeat on the medium-term prospects, but again, important challenges to bear in mind.
All right. Well, thanks very much indeed for that. Paul Guest of Lasalle Investment Management. And that's a business wrap from me for now. Back over to Steve.